you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? Welcome to Weekend Recap on the Courtside Financial Podcast, a segment where we bring you a compilation of everything that went down throughout the week from a stories perspective. Before we get into this video, make sure you hit the like button, make sure you hit the subscribe button, and click the notification bell icon so you don't miss out on any content that's coming in the future. In today's episode, we'll be talking about how NIO needs to address their sales problem sooner rather than later. So NIO burned almost $2 billion just last year, and they're expected to burn even more cash this year. With Q1, they reported a net loss of around $690 million. So even with investor funding and more money coming into the stock, NIO still has a very serious problem given the burn rate currently. To tackle this situation, it's likely that NIO is going to have to raise even more capital and secure funding for the next 3 years. However, it's important that NIO doesn't just focus on cash flow and securing funding. They also have to fix the problem at its root, which is increasing their sales. If NIO continues to have the current number of sales that they're having, even significant funding won't be enough to keep the company afloat. At a certain point, William Lee, CEO and co-founder of NIO, even said that if NIO continues to sell what it's selling, him and Quinn Lee Hong, co-founder and president, will have to find new jobs. This statement underscores the urgency of addressing NIO's sales challenges. Now, NIO has taken some steps to address their sales challenges. At first, they were very adamant about the fact that they wouldn't partake in the price war that was caused by Tesla, who has been kind of dictating for the rest of the market to cut prices as well. Well, after some disappointing sales figures came out, and I'm sure investors voicing their opinion that they're not so happy about what was going on with NIO. Why is it selling less than Li Auto? Why is it selling less than Xpeng as well? NIO felt pressure to actually end up cutting their prices by 30,000 yuan, which is around $4,200 if I recall correctly. But one of the big problems here is the market segment that NIO's in, which is why I've been harping on the Alps brand so much about it being released next year, and this could be a game changer, an inflection point, is that the high-end market isn't very profitable for electric vehicles right now. The core needs of high-end buyers have not been fully met at this point. The current limitations as far as battery technology, battery life, and charging infrastructure are preventing high-end electric vehicles from replacing their gasoline counterparts. To address these challenges, NIO's taking a multifaceted approach. They released the ET5 Touring, which is a station wagon, and if you know, or if you watched the video I put out not too long ago, the station market wagon in China is almost non-existent. Chinese consumers, station wagons make up a little bit over 8% of the Chinese market. So it's clear to see from the market that Chinese consumers are not really choosing station wagons right now. Now, is that because it has never been done correctly, or is that because there's just lack of interest? That's why I called this a 50-50 bet. If NIO succeeds, then they'll be able to capture and also knock down the door for a new market, making them the leader in it. But if they fail, they'll have wasted a lot of energy and investment into the station wagon market. Now, for Europe, on the other hand, they tend to love station wagons over there. So I think that this car will be pretty successful in Europe, but NIO isn't really selling nearly as many cars in Europe as it is in China right now for them to justify taking on this expense if it doesn't work out. Secondly, NIO is diversifying their product into the lower end market as well, because they realize the problems that I just outlined earlier. There's a lot of problems when it comes to the high-end EV market, and for NIO to reach scale, I really do believe that they're going to need a brand that is going to be able to appeal to a wider audience, and that's where the Alps and the Firefly brand come in. The Alps brand is going to be NIO's mass market vehicle brand from the 200,000 to 300,000 yuan price point, and that's going to come out in China, and they don't need to change their infrastructure around. It'll be able to operate on NIO's same infrastructure with battery as a service or battery swapping or anything that you can get out of NIO today from a battery technology perspective. The Firefly brand will be even cheaper. It's supposed to roll out in Europe. That's going to be from the 100,000 to 200,000 yuan price point. And so I think that both of these brands that are expected to release next year could help NIO reach scale and sell a lot more cars faster and help the problem that they're currently facing as far as sales. This strategy will help NIO compete against cheaper electric vehicle makers such as BYD or GAC as well, who are making these cheap cars that are selling pretty fast. But guess what? NIO has a better technology, in my opinion. Entering the low-end market can also be a challenge, though. Oftentimes it's a race to the bottom, but we'll have to see how things play out. I think with the price point that they're at, with the with the tax exemptions that they'll receive in China as well, which is favored towards battery swapping, and then also having battery as a service, I think NIO can come in at really competitive prices with the Alps brand, and obviously the Firefly brand is going to be priced even cheaper in Europe. Now, at one point on this channel, there was a time when we were talking about NIO having plans of European expansion, and guess what? They actually are in Europe at this point in time. They first entered Norway. The company plans to gradually expand its footprint in the European market, and if they're able to do that, that'll help out the company big time. This move will allow NIO to tap into growing demand for electric vehicles in Europe, and then also diversify its client base, which is obviously going to help out sales in the long run if successful. Additionally, NIO is very adamant about expanding its infrastructure wherever they go. They know that they need to get more infrastructure on the ground in Europe, and they've been consistently expanding their infrastructure in China as well, which is going to give consumers of all three of these brands in the future, NIO, Alps, Firefly, a real reason to purchase NIO, and it's going to kind of widen the moat through infrastructure as well. They have NIO Power Swap, which allows users to quickly switch out their batteries for a full battery in under 5 minutes. They also have superchargers just like Tesla, and they're putting more of those on the ground. They also have charging piles, destination chargers. So with NIO, it's really kind of pick your own flavor. How do you want to charge your electric vehicle? And I think that once they have a lot of infrastructure on the ground, the decision will be easy for consumers. That's the reason a lot of people in the US choose a Tesla over any other electric vehicle, because Tesla just has the infrastructure on the ground, and NIO's made this a focus point for them as well. And I think that's the logic behind it. All of NIO's new vehicles are coming out on their second generation platform, which is NT 2.0. And on this platform, NIO aims to kind of deliver cutting edge technology and differentiate itself from the market, and even differentiate themselves from their NT 1.0 platform. So I make this video to make the point that yes, NIO has received funding from an entity in Abu Dhabi, but NIO's likely going to have to raise more capital, especially with their short-term liabilities, debt that they have to pay over the next 12 months. And so to raise more capital, they have to really show investors something. And when I say show investors something, I mean that means that NIO as a company needs to really increase their sales. And so all these things that they're doing are efforts to increase their sales and really strike an inflection point here. By focusing on these areas, NIO aims to increase its sales, overcome its current challenges, and really position itself as a leader in the electric vehicle market globally, and especially in China to start. Today we're going to be responding to someone who is bearish on NIO and has left a comment on the last video that I posted. Now this person has bankruptcy fears, and like I responded to his comment when I get done with everything that I was doing today, because I did have a lot to do today. It is 8:19 over here where I'm just now recording this video. I was going to respond to him with a comprehensive video. Okay, so this guy Dulu Mulu, I believe, said, I don't think there's an issue of just finding additional funding with NIO. It's a bit worse than that. As I posted in another video, What you didn't spend too much time on in this video, unfortunately, purposefully, from NIO's Q1 earning is that of March 31st, they have about 14 billion RMB in cash, but NIO also has about 40 billion RMB in short-term liabilities. That's a lot of money, of which short-term loans and account payable notes together alone exceed 24 billion RMB. Which means they need to pay suppliers, payrolls, or other entities short-term, meaning ASAP, more money than they currently have as cash on hand. They are effectively, by definition, bankrupt. Now let me pause right there because that statement's false. You guys stay tuned. We're going to get into my complete refutation, and I do want to know what you guys think below. But back to what he was saying. They are also incidentally burning about $600 million per quarter US dollars. To put this into perspective, in 2019, they had far less liabilities and were close to shutting down operations until the Hefei government bailed them out in a last-minute operation. They had already delayed paying salaries at the start of 2020. This cash infusion of $740 million, 5.3 billion RMB from the Abu Dhabi fund is only a small desperate band-aid compared to NIO's current dire financial situation. The situation is so bad, in fact, that NIO is willing to sell 5% of the company to the Emirates to get it and issuing, i.e. diluting the stock. And not to forget Tencent, one of NIO's angel investors / founders, which once held the biggest amount of shares, about 124 million Class A shares, was willing to liquidate 48 million shares at $8.47. Yes, $8, not 30, not 20, not 10, but $8. That should give a pretty good idea of how big money in China is believing in NIO. Tencent has now reduced their stake in NIO to about 76 million shares. That's about a 40% haircut. Check the latest SEC filing form. Blah, blah, blah. I already read this way before you commented. The question is now, will they find someone else that is gullible enough to invest in this broken business venture, which seems to be pretty far off from anything that remotely smells like profitability? My thing here is, if you don't like a company, why are you consistently following it and consistently making commentary on it and worried about where I put my money? Mostly speak on news about the company because I like to follow the company and it keeps me intertwined and in tune with what's going on. This whole entire channel just happens to be a byproduct of that. But anyways, we'll get into what I have to say right now. First, let's clarify a few things to ensure an accurate understanding for the viewers here. You say that NIO has 14 billion RMB in cash after their Q1's earning. That is not true. You can simply go look at the Q1 earnings report, and what you'll see is that NIO has about 37.8 billion RMB in cash, which equates to about 5.5 billion as of March 31st, 2023. Additionally, the recent cash infusion from the Abu Dhabi-backed firm CYVN of around 740 million puts NIO to a stronger cash position of closer to over 6.2 billion US dollars for the conversion. So your first statement is completely wrong here. Now, CYVN currently holds a 7% stake in NIO after everything is said and done. They've gained 5% through new shares via way of dilution, and then they were so confident in NIO that they actually went and bought an extra about 2% from Tencent, like you mentioned in your comment. This demonstrates NIO's capital raising ability, the confidence and support that they're able to get from strategic investors. Now, NIO's current liabilities were 5.9 billion as of Q1 2023. That's a number that needs to be carefully managed, correct? I won't ignore that. It's worth knowing that NIO, like many growing companies, will need additional capital in the future. This is a common practice to support R&D and expansion initiatives. And you making it a clear statement saying that Tencent selling their shares is the opposite of a vote of confidence in NIO is not true. We don't have any clarification on that. That's your speculation. It's important to consider that companies are always making strategic decisions based on their financial needs. Tencent still has over 70 million shares of NIO, which is no small number, and that means that they want NIO to succeed as well. Tencent isn't in this to lose money, and they have a massive amount on the table when it comes to NIO. So if them selling their shares and bringing in additional help can help the business, that could also be an option as well. So if you're gonna speculate, you have to provide both sides of the story there. It's interesting to compare NIO's financial journey with that of Tesla, NIO being 9 years old, being founded in 2014, and it also took Tesla 17 years to turn a profit. Both companies have faced financial challenges along the way. If we were to extrapolate this guy's same logic for why NIO is going to go bankrupt, then we would also have to say that Tesla is going to go bankrupt as well. And that's just ludicrous to me. And what I mean by that is based on their cash on hand deficit towards their current liabilities. Tesla's current liabilities have been growing every single year. And I'm speaking about Tesla today. In my opinion, growth companies have their challenges, but I'm optimistic amongst all the bankruptcy chatter when it comes to NIO right now. For the quarter ending March 31st, 2023, Tesla's total current liability were just under $27.5 billion, representing a 27.88% increase year over year. Yet Tesla continues to thrive and expand, demonstrating that a deficit between cash on hand and current liabilities doesn't necessarily indicate an imminent bankruptcy. I welcome all different opinions, and I thank this viewer for raising these points and allowing us to further provide insights into NIO's financial situation. Today we're going to be talking about some significant moves that NIO has been making as of recent, some of which I wanted to talk about yesterday, but I was busy responding to a bear. Without further ado, let's get right into it. Our first topic of the day is NIO's collaboration with CNOOC, one of China's largest 3 oil companies. This partnership marks a strategic relationship between NIO and CNOOC as they both strive to become integrated energy service providers. By taking on this partnership, NIO gains access to secure locations and comprehensive services which will facilitate the rapid expansion of their battery swapping network. This is a crucial step for NIO as they strive to meet the growing demand for electric vehicles and contribute to China's carbon neutral targets. It gives NIO access to a vast network of resources and expertise that they otherwise would not have. CNOOC, as I mentioned earlier, is a huge player in this industry, and their experience will be invaluable to NIO. Now, this is going to be super helpful for NIO as it takes some of the burden off of their shoulders as far as having to use their own resources for all of these battery swapping stations, which we all know can be costly. You can liken this somewhat to the collaboration between Shell in the past with NIO or Sinopec. Moving on to our next topic, NIO has recently made the new ES8 available for order. The new ES8 is an impressive addition to NIO's lineup. It's built on the NT 2.0 platform. With its spacious and luxury design, the ES8 offers consumers a premium electric SUV experience. Having this model available for order will round out the portfolio. It is one of the more expensive models, so having it qualify for subsidies is kind of tricky, but nonetheless, the new ES8 is a significant product launch for NIO. This platform is designed to be more efficient and powerful than previous platforms. Lastly, let's discuss what I wanted to discuss yesterday, the growing demand for NIO vehicles according to the Chinese Vehicle Registration Report. The report indicates that NIO's sales have been on the rise with steady increases in sales numbers. NIO sold 3,200 units last week and a total of 8,000 units between June 1st and June 25th. These numbers demonstrate strong demand for NIO vehicles, especially with the introduction of new models like the ES6 and the ET5 Touring. NIO has set a target of delivering between 10,187 and 12,187 vehicles in June, and they seem to be on track to achieve that goal. It's encouraging to see NIO finally beginning to turn the story around as far as deliveries. I know that there was a lot of negativity around that, which was definitely being reflected in the stock price as well, in my opinion. NIO expanding their product lineup seems to be resonating with consumers, so all 3 of these things are good news here today. The strategic collaborations and innovative business models employed by NIO demonstrate their commitment to providing reliable and sustainable transportation options. Today we're going to be talking about why NIO expanding on their infrastructure is so very critical to them succeeding as a business. Now, I've talked about this a lot of times on the channel before, but I want to approach it from an angle that really highlights the why for those who don't understand. So yesterday we talked about NIO's partnership with CNOOC to continue expanding their infrastructure, which was pretty huge, but let's get to the root of why NIO is so aggressively building out their charging infrastructure. So we've talked about this as well on the channel before. President and CEO of NIO, William Lee, has expressed that they would like to be doing more in Europe than they're doing today. They are not up to expectations. And I'm paraphrasing here, but he also said that what they need to focus on is building the infrastructure, and that's the most important thing. NIO's strategy of creating infrastructure such as battery swapping stations and charging piles lays the foundation for their long-term success and revenue growth in the future. Now I'm going to be approaching this from the angle of their sales and success in lower-end cities. NIO's charging infrastructure is very limited in lower-end cities, and so with them continuing to expand their infrastructure footprint, over time, that's going to position them pretty well to capture more market share and also capture some revenue from other companies who are seeking to utilize their infrastructure in the future. You might be thinking that's an interesting perspective, that their lack of infrastructure in lower tier cities could be affecting their sales. Well, it's true, and in this video we're going to get into the numbers and the facts here. Consumers in lower tier cities are driven by more practical considerations. At present, there's a shortage of charging or refueling infrastructure for pure electric vehicles. As a result, these consumers in these lower end cities are opting for ICE vehicles still, or plug-in hybrids. They want vehicles that can meet their immediate transportation needs without being hindered by the limitations of charging infrastructure. Until the charging infrastructure catches up in these cities, consumers are going to continue to be making pragmatic choices. This is why a company like Li Auto is currently outselling NIO in the present. Now, I'm not invested in Li Auto, and I don't believe that Li Auto will do better than NIO in the long term. But at present, like I mentioned, these consumers are making pragmatic choices, and so Li Auto gives them a little bit more flexibility. If you think about BMW in China, even their hybrid vehicles are outselling NIO as well. And if you think about BMW as a whole, another reason that they are outselling in these lower tier cities is because they have about 700 stores, which consumers in these lower tier cities, they obviously want to test drive a car before purchasing it, and NIO is more of a direct to consumer model. BMW's stores stretch across all of China, even into these lower tier cities. Li Auto CEO claims that BMW has effective coverage in almost 200 cities. A lot of consumers in these smaller cities as well are first-time luxury automobile buyers, so that's also why BMW is having much success in terms of deliveries. The taste and desires of the older generation are more likely to be reflected in this younger generation in this demographic. They might be unfamiliar with NIO, but they definitely know BMW, and it definitely has a status symbol. Now, I'm not worried at all. I think NIO will succeed in the long run. I think that they make a great product, and I think that they're making great decisions around their products as well. Some data on China here is that China boasts the world's largest charging infrastructure. Just last month, they reached 6.35 million charging piles in the country alone. Even so, the distribution of charging piles is not really balanced. More than 25% of the charging piles in China are near the Pearl River Delta, where Guangdong have put 460,000 as of May just this year. Approximately 15% of China's energy suppliers are located in Shanghai and Beijing. Now, this tells you that there's just clearly an imbalance of resources, and these smaller cities can't comprehend. Charging infrastructure is lacking in both quality and quantity in these smaller cities. Local governments are hesitant to invest since it would be a large investment up front for a very slow return. Now, going back to NIO, recently they decided to stop free battery swapping altogether. Now, Why did they do this? Because there's no such thing as free battery swapping. There was never any such thing as free battery swapping. Essentially, it's a hidden cost. Consumers are actually paying for that when they pay for the NIO vehicle. And so consumers in these smaller cities where there's not really any battery swapping stations are really paying for consumers in the larger cities to reap all the benefits, while the consumers in the smaller cities do not. This obviously creates an inequitable situation for the consumers in the smaller cities. Aside from just trying to make more profit, I believe that this is one of the reasons that NIO has actually decided to do away with this freebie. It's an important adjustment to ensure fairness and align costs with benefits. Hopefully by this point in the video, you can see that when NIO says that they really need to continue expanding on their infrastructure, expanding on their battery swapping stations, expanding on their charging piles, it's ultimately in an effort to increase revenue, an effort to increase sales. NIO's approach moving forward should really focus on the key aspect of doing this. This is obviously going to require collaboration with local governments, private entities, and other stakeholders to build a robust charging ecosystem all over China that removes one of the biggest pain points for all consumers, which is refueling. I think that my suggestion, and I wouldn't even call it a suggestion because this is something that the company knows and understands if you've been watching William Li, if you've been watching them speak about what they're doing as far as charging infrastructure and the ambitions that they have around it. So I won't call it a suggestion, but I'll say it's important for NIO's future growth. This really just goes to show that NIO is a long-term play. Have you ever seen that movie, If You Build It, They Will Come? That's kind of how I think about NIO. Today we're going to be talking about NIO's relentless infrastructure pursuits that resemble Amazon's not too long ago. In 2013, Mad Money host Jim Cramer was given credit for coming up with the term FANG. Originally, it included 4 high-growth tech stocks that he recommended: Facebook, Amazon, Netflix, and Google. All American technological powerhouses which have served those who had invested at the time very well. There's been an extra A which has been added, which is Apple, which needs no introduction, and the N for Netflix is also being replaced with Microsoft, which is a stock that Wall Street loves. Anyways, for the purposes of this video, let's just keep it as FANG because that could turn into a completely separate discussion, which we're not looking to get into today. Amazon, an original FANG stock, had not reached its exuberant highs without question of whether the company's making the right decisions or not. To dive into the topic that I want to talk about today, infrastructure, we don't have to look too far back. So to kick things off, let's rewind and kind of set the stage here. 2017. Many Amazon shareholders were very critical of the company because it had reached an all-time high of $7.2 billion in shipping losses in 2016. The e-commerce giant started its own self-fulfilled delivery service in 2014, fulfilled by Amazon, and that's when we started seeing these blue Amazon trucks driving around, even stopping by our doorsteps to drop off packages. In the early 21st century, Amazon relied on third-party companies such as FedEx and UPS to deliver our packages. Today, fulfilled by Amazon may seem like a good idea, but as I mentioned, in the past, it was something that people were very questionable of and very critical of. Spending a ton of money on logistics infrastructure and going up against big names who had more time to mature in the space was in fact a risky bet. In the short term, losses continued to mount and increase, and the proof just seemed to be in the numbers that this was not a good idea. Since Amazon has been expanding its delivery services into ocean freights, semi-trucks, and drone, and really the only reason that the company was able to turn a profit was because of its cloud infrastructure arm, AWS, or Amazon Web Services. So you really have to put yourself in the place of shareholders and imagine how they felt at the time. The sentiment for the most part probably was that it just isn't working. Fast forward to today, putting all this money into logistics infrastructures has turned into a competitive advantage for Amazon. Amazon went from being dependent on these third-party companies to delivering 22% of all packages in 2021. As a benchmark, FedEx had 19% market share and UPS had 24% market share. Now they're on track to become the world's largest logistics company. Customers are choosing Amazon because of convenience. Creating a moat through infrastructure has clearly been proven effective in the e-commerce industry. Is NIO trying to do the same thing in electric vehicles? CEO and Chairman William Li believes that building out the infrastructure is something that's going to be critical and crucial to NIO's success in the future. To quote him, he views it as planting trees now to enjoy the shade later. I wonder if he took a page out of Amazon's book, but in my opinion, he definitely took a page out of Tesla's book. Tesla has the most mature charging network built out in the US. Unlike many other competitors, they're not relying on third party. They're putting as much focus on electric vehicles as they are on the infrastructure that's powering those vehicles. Infrastructure is costly. You should have gotten that from this video already. That's certainly probably part of the reason that it took Tesla 16 years to become profitable. But in the words of William Lee, they planted the trees first, now they get to enjoy the shade. In February, the White House announced that Tesla, with the support of $7.5 billion in government subsidies, will open a portion of its US supercharger and destination charger network to non-Tesla EVs. This is huge as it will provide another source of revenue to the company without having to deliver more cars. The charging business is lucrative, but that's another video. I don't want to deviate too much from this one. Now, NIO has received many subsidies from the Chinese government to build charging infrastructure as well, battery swapping stations, fast charging, etc. Tesla and NIO are being chosen because of their technology. They have the best and most mature technology, but not only that, they already have proven product that's out on the streets. They have infrastructure stood up already and it's working, but not only working, but working well. Getting ahead in the field of electric vehicles involves so much more than just selling cars. I believe that NIO needs to get as much infrastructure on the ground as quickly as they possibly can. And I also believe that they're making the same bet that a tech giant like Amazon has made in the past. Not to mention that China has already chosen battery swapping as a preferred method of refueling, and they're looking to standardize it in the future. NIO at some point may be asked to standardize their battery swapping technology. And like we're seeing Tesla, who's more mature in the space right now, battery swapping can certainly become a form of revenue for the company without them having to deliver more cars. Put it simple, NIO's the best at battery swapping in the world. Their ultra-fast charging piles are already open to most EV brands as well. To top it off, a lot of R&D spend is going into charging technologies, and trust me, it's a lot. It's in the billions. If it works out the way that things did with Amazon and soon to be Tesla, I think that history will repeat itself to NIO's avail. That's going to be it for this episode of Week in Recap for the Courtside Financial Podcast. If you found any of this information valuable, make sure you hit the like button, make sure you hit the subscribe button, and definitely leave a comment down below. Genuinely interested in hearing what you guys think about these this new style of videos that we're doing. Anyways, that's going to be it. I'll catch you guys next time.